Hello once again, investors. This is the Conservative Trader at theconservativetrader.blogspot.com. Quick preview of my website on the screen there, as you can see. This week I want to talk about conservative trading again from the point of view of risk control. On my last video we spoke about risk control, and I conveyed to you how you can buy a broad range of stocks with very little risk involved, and that was achieved by buying your first stock. Once it becomes profitable, buying your second, third, fourth stock, etc. This week I'd like to take a slightly different approach, although we're still talking about risk control. The company I've selected this week is TQNT Semiconductors. You can see on the screen that they've got very good earnings. My mouse is over the earnings quarter to quarter. You can see that in fact they've got phenomenal growth right now in earnings. And over on the left hand side you can see the revenue increasing, but this is besides the point. I'd like to talk about TQNT from a technical point of view, looking at the graph. If I can call up the graph, and as I said, I'd like to talk about buying stocks with very little risk. In other words, very little money at risk. And once again, like I said, last week we talked about buying many stocks. This week I'd like to talk about buying one stock and building up positions and increasing your position in that one stock only. And the way to achieve that and still have very little risk is to use a small amount of money for your initial purchase. And let's assume we do that in mid-September, where you see this high volume breakout. You see my mouse over it. Stock jumps up and the stock starts moving up. That very small purchase you made, you might have made it when the stock price was $8.65, and you might have had a stop at about $7.80. As the stock starts moving up, you can see it now goes into this consolidation area in the October time frame. You can now move up that stop so it's at your buying price. So now if the stock was to fall, you have no money at risk. Because you have no money at risk, you can now consider pyramiding more money into this stock. So again, you see a breakout from this consolidation at about 986. So you might buy a similar amount of stock in the same company, TQNT, at around 994. And again, you'll put a stop price for this second batch of stock at around 940. As the stock moves up to the area of $10.60, you might raise the stop on your second batch of stock that you purchased. So that is also at break even if the stock was to fall and you get stopped out. So again, you've now got two blocks of stock, and you're in both of those positions with zero net risk, because you have stops at the buying price. You might decide to buy stock again around 1089 with a stop at 1032. As the stock goes up, let's say to 1190, you raise the stop on your third purchase, so again you're in at break even. So you can see the strategy here. As the stock moves up, we raise our stops, so if we do get stopped out, we get stopped out at break even. And if it's a strong stock, we continue buying more, each time with the stop loss at 5 or 10% under your purchase price. And as the stock moves up, you raise the stop up to the purchase price, so again you're out at break even, and you keep buying more stock as it continues increasing. Preferably you'd like to buy stock as it breaks out each time. So you can see that with this form of pyramiding, you can keep buying into a successful company as it moves up, buying many times, and your risk profile is negligible, because each of those previous purchases you will be out at break even if the stock was to collapse. Let's take one of those cases. Let's say in late November you bought the stock at 11.94. The stock started moving up to 13.13. You have all your other positions down here which are all safe because you know you can get out to break even. And the stock starts falling in December. You might be stopped out on the last position you bought, and you would in fact be stopped out at break even because as the stock moved up in early December, you raised your stop. So that last purchase, if you were stopped out, you would have been stopped out at break even. As the stock falls, you hold off on your buying and you wait and see what happens. And again in January, the stock starts moving up again, so you resume your buying. You make a purchase, stop underneath it. As the stock rises, you raise the stop, so again it's at break even. You never buy more stock until your last purchase you know you can achieve break even on. Each of these cases I've discussed with you, you don't lose any money, but it might be that there's a situation where, let's say you buy the stock in early December at 12.89, you have a stop perhaps at 11.76, and before you've got a chance to raise that stop, you get stopped out with maybe a 5 or 10% loss. In this situation, before you think about buying any more stock, you need to recover that loss. The way you recover that 5 or 10% loss is you look down at your first purchase down here, which you might recall the stop is at your break-even price where you purchased it. Raise that stop to cover the 5 or 10% that you lost up here. So again, you're now in this position with net no loss. You've covered the loss that happened in December with the initial purchase you made at September. So revising here, every time the stock goes up, you buy more stock. You take out a new stop position, and as soon as possible you raise a stop to break even. If you're in the unlucky position where you are unable to raise that stop in time and you did take a small loss, you take any one of these purchases that you bought much further down and you raise the stop on that to cover the loss you made up in this area. So you can see that you are very much in control, and you carry on raising your stops and buying more stock as it continues on up. At some point up here there will be a high volume sell-off as the trend ends. At that point, each of these purchases you made where the stops are sitting at break even, you sell them all in one purchase, or you sell half of your holding, depending on what the situation is. But you can see that all of these purchases are profitable for you, and if this stock was to go sour, you're going to sell out up in this area on all of those purchases. So I've discussed risk control in my last two videos. The first point of view was using your profits to buy a broad range of positions. So ultimately you own 5, 10, 15 positions. In my latest video, today's video, you're buying one position and you're pyramiding that position with very little or no risk. As the stock moves up, you keep adding to it and adding to it, and eventually when the trend changes, you're going to sell that stock and each of those positions will be sold profitable. That's all I wish to say today, traders, and I wish you a good week. Bye.